Welcome to the Retirement Learning Lab, where we teach you how to retire without running out of money. My name is Van Richards, and this is the Daily Stock Analysis. Welcome to the show today. We have a lot of really good information to share with you. Wow, it's been a crazy day. All the markets are up. Just last week, after President Trump was diagnosed with the coronavirus, the market whipsawed back and forth. We saw the shares of Regeneron and of Gilead spike because he was using the medicine. Today, they were up about 7%. That is Regeneron, but based on the fact that he had used the medicine. And, look, I want to talk to you just real brief before we get into the show today about the two different stocks we're going to talk about and tell you something about my opinion on the pharmaceutical companies that are developing the treatments and also the vaccines for the coronavirus. If you look at it from the standpoint of the usefulness of the drugs that they're developing, it's probably going to be a short window. There's no vaccine for it yet. There's not one that's been approved. Let's put it that way. But the concept is that with a vaccine for a virus, it doesn't matter whether it's a flu virus or the coronavirus or whatever the case is going to be, it's generally going to be a short-lived window. The coronavirus probably is not going to be a disease that's going to be with us forever. If you look at the value of a drug, think of how long that the value of that drug would be around. You will probably have a better market value for a drug for a treatment for something like macular degeneration or for cancer or for hepatitis or something like that. A disease that is an ongoing problem that there's really no cure for from that standpoint. Now, there's no cure for the coronavirus. There are vaccines for it, which will prevent it. It's just the difference in the type of the illnesses. The long-term benefit of a drug or a treatment for the coronavirus will be less valuable to a pharmaceutical company than something like a cancer drug. So keep that in mind when you're thinking about investing in these companies. Another thing to consider is that we've been talking about the coronavirus since February and March. The shares of some of these companies has gone up quite a bit. So the idea is that if you jump in right now because President Trump has been using remdesivir or the other cocktail drug that come out from Regeneron, you might be buying in at the peak of these particular investments. So keep that in mind when you're thinking about investing. Another thing to keep in mind too is as we go into the stocks that we're going to talk about today, both of these stocks are growth stocks. Now, with growth stocks, the idea is that generally growth stocks trade very far or quite a bit further than their actual fair market value. And you're going to see that in the stocks that we're talking about today. They're generally considered overpriced when we talk about their fair market value. And the fair market value is calculated on a multiple of earnings or a multiple of sales. From that standpoint, it's not just something that somebody picks out of the air and goes, I think that's the price that I'd like to have. That's not the way it works. The idea is that they base that fair market value on something that's real. The price, on the other hand, when we look at it, we're going to look at one drug today that's close to 100% overpriced. And not a drug. We're going to look at a stock that's going to be about 70 or 80% overpriced, let's say. So the idea is going to be that there's a lot more room, hypothetically, that stock could draw back. So keep that in mind as we're talking about some of these things today. Let me go to the screen just a little bit and make it a little bit bigger for you so that you can see what's going on. And let's get into talking about Synopsys and Splunk. It's a good possibility that these are two companies that you may have never heard of unless you were in the particular industry, but they touch your lives in ways that you might not recognize. Let's first take a look at Synopsys. This is a short little explanation that tells you, gives you an idea of what they do. Synopsys is a unique company. It really has three different areas, as you saw there on the video. A year ago, it was trading at $137.89 a share, and today it ended up, wow, 216.64 for a whopping 57.11%. Now, if we go back 5 years, let's just take a look at this for grins. If we go back 5 years, it was trading at $48.04. When we factor in today's price, that is a whopping 350% in 5 years. That's an APR, an annual percentage rate, if I can spit it out there, of 35.15%. Friends, the past performance is not going to be indicative of the future results. And I think that you can recognize that from that standpoint. It's been a good run from that viewpoint. Now, here, I want to talk to you just a real quick second about this before we go into it. There are three things that we look for in stocks when we're talking about a quality stock. The first thing that we're going to look at is we're going to look at earnings. And when we look at earnings, we're going to look at expected earnings and actually the actual earnings in itself. Then the second thing that we're going to look at is we're going to look at the competitiveness of the company, and then we're going to look at the stability. So let's go back over to the screen real quick and look at what the actual earnings, the estimated and the actual earnings have been. And, you know, I don't think I need to make the screen much bigger. You can see that with Synopsys that almost, except in 2017, where you see the dancing cursor right here, where you see the dancing cursor, you see that they were way, way under their actual earnings. That happened one time in, since 2014. So the actual earnings on this has been very, very good. The thing about Synopsys is this. Here, let me go to the next screen. There's no dividends. We're going to go past that. We want to look at how they compete with other companies too. So we have to look at companies that do something similar. You're going to have really three different companies that are involved in the type of business that Synopsys is. Because when you think about it, what Synopsys does is Synopsys helps companies to design better microchips, better semiconductors. And they have particular traits in mind. This is the type of company that I won't say that there's no competition, but there's very little competition. There's only really two different companies out there that compete very heavily for the same type of business. One is called Cadence Design. The other is, actually, it used to be Mentor Graphics, and in 2017, it was purchased by Siemens. The size of the companies, except for Siemens, is a lot more diversified in what they do. But as far as like the size of Synopsys and Cadence, they're pretty close to each other from that standpoint. And they have specific areas which they excel over top of the other. Yes, Synopsys probably could come in and take business that Cadence is doing, the same thing in the chip design business. But when it comes to their specialties, Synopsys really specializes in verification. Cadence specializes in the logic design, and then the physical designs expertise probably would be attributed more to Mentor Graphics or Siemens in itself. But remember though, even though as we're looking at these three different companies, they are tracking with each other pretty close. So if you ask, is Synopsys a very competitive company? Then the answer would be yes, they're a very competitive company. Now, what makes it so that they're able to hold off from their actual competitors? When we get to this part, we start talking about the moat of a company. Remember, this is what a moat is. Remember, the moat is that imaginary barrier. It's that imaginary barrier which is in between the company and their actual competitors. So when we look at Synopsys and Cadence and Mentor Graphics or Siemens, we have to look at what sets Synopsys apart. I think that really the first thing that you're going to think of with Synopsys as far as software goes, the biggest thing that they have that's a benefit is the switching cost. It's not such a huge cost of switching that it makes it impossible for a user of Synopsys to not go to Cadence or to not go to Siemens for their help with their chip design. But the point is going to be this. Whenever you're making a particular semiconductor or microchip, it's in a particular application. Let's say, for example, that you're going to use it in cars, for example, in self-driving cars or something like that. There's a very, very thin window of tolerance in there, and they have to be very, very accurate. So you may have a manufacturer, whether it would be an automotive manufacturer or whether it be any other type of manufacturer that uses semiconductors. There's a very, very thin tolerance of error. So these companies, they're sticky because they don't want to go to another manufacturer, another company, software design company like Cadence or whatever, even though that they're reputable companies. They don't want to go to another company because there may be some error in there from the standpoint of the creation of the chips, and that could have an impact on their end result on their products. So the actual switching cost comes into the actual changing of the design specifications to make sure that they're fitting into where they should go. The other switching cost is just getting accustomed to it. You're going to find that with some of these companies, whether it's going to be Cadence or Synopsys or Siemens, that engineers use this, they begin using it when they're in college. And if you begin using a particular type of software when you're in a college scenario, a lot of times you're going to continue on with that. Or if you get to your new employer and you have any opportunity to switch, that may be an influence for you to switch as well. So the idea of the switching cost, that's one of the biggest moat creators that's out there. But I want to make sure that I give you an understanding that that switching cost is not so big that it is inhibitive. In other words, if Synopsys all of a sudden raised its price, it actually has an enterprise price, that specializes in particular businesses, and it has a cloud business currently too. Either one of those, if they raise their prices significantly, you would find that as a pretty good reason for another company to go, an end user to go over to a company like Cadence or to Siemens from that standpoint. So that makes a big difference from the usability of a particular stock in itself. Let's take a look and see actually what Morningstar says about Synopsys, because you're going to find this one very interesting. The fair market value that Morningstar is putting on Synopsys is actually $112 per share. That means that right now that Synopsys, according to Morningstar, is 91.87% overpriced. Well, I don't know. I think that comes along too with the fact that they are overpriced, but the problem is going to be there's not a lot of other companies that do what they do. And when chip makers are pushed up against the idea that they have to keep improving their chips and they have to keep pushing forward to make production better and better and better to be competitive, they're going to stick with the company, the developing company, the software developing company that they have got there on. In other words, they're going to keep what they've got. So the idea is right now, what Morningstar is looking at is they're looking at giving this company a 1 star. But I will tell you, it is a unique company. But look, there's also something that I want to talk to you about. There was an article in today's Wall Street Journal that that I think that bears some discussion from the standpoint of some of these companies that are selling at a premium. And that would include companies like any of the tech companies. It would include Apple and Google and Tesla and a lot of other different companies out there that are trading at actually a premium over top of what their earnings may be. Right now, what we're looking at, and this is coming to light from the standpoint of a lot of Wall Street experts, that should there be a Biden presidency, there is probably going to be a big interruption in growth stocks. So if you own the NASDAQ 100, there's a good possibility that a Biden administration could cause those stocks to lose quite a bit One article that I was reading that was in the Wall Street Journal today, actually is over the weekend, said something around 20, 27, 28% from that standpoint. Don't quote me on that, but it's a pretty big drop that you could expect in actual production and actual value based on the fact that a Biden presidency is going to tax corporate America a lot. They're going to have to tax them a lot to pay for a lot of the programs that they are proposing from that standpoint. Now, how's that going to affect you on the end of the investor? Well, if you're a tech investor, you might want to consider looking at value also. Now, I did a blog post last week that was called "How to Invest $1 Million in the Stock Market," and it's really structured around the idea of diversification. And when you look at that, if you go back and you look out on my website at richardsfinancialplanning.com and you go down at the bottom of the page, you're going to find the blog section. You click on the blog and you'll find it is the first one that's up. And when you go through that blog, look for the graph. You're going to have a graph and it's going to have several different pie charts on it. And on those pie charts, what it's doing is it's showing you the different allocations of how the money would be invested. And a lot of money being put into growth stocks is a much more aggressive tactic, especially going into a Democrat presidency, because growth stocks, the taxation of these companies will impact their value significantly. Okay, so I don't want to make this political. So let's get on into the next stock that we're talking about from the standpoint of today. Let's move on. Before we do that, I want to make the screen just a little bit bigger so that you can see what some of the other analysts are saying about Synopsys. There were 11 analysts that were polled. 9 of them said that it was a strong buy, and 2 of them said that it was a moderate buy. Nobody's saying hold or sell. So when you take out the average, this is what you get. Actually, what you get is a very strong buy for Synopsys from the average analyst opinion. Remember, this is not my recommendation to buy or sell. I'm just reporting to you what the other analysts are saying out there. And they're saying that this is really a very strong buy from that standpoint. And a strong buy is different than it's going to be different than looking at the fair market value, because this is going to have to do with the consensus and the momentum behind the stock and their opinion for forward looking from that standpoint. I will say that the analyst polls were taken before a lot of this news about the Democrat impact on the economy going forward from that standpoint. So, okay, let's look at our next stock that we're talking about. This is for Splunk. You might not be familiar with Splunk either, but after today, you should. Take a look and see actually what Splunk does. Splunk is actually a big data company. You're going to find it very interesting looking at Splunk because this is another really good tech history. If we go back and we look a year, 121.36 a year ago, and then today it closed at a 194. Wow, 59.91%. That's amazing. Look, I tell you this all the time. The past performance is not going to be a guarantee of the future results, but there's no dividend either. But okay, look, hang on to your hats on this one because the earnings are all over the place. This is a company that doesn't have a lot of competition in what they do, because what they do is they use big data and they call it schema on the fly. They actually are able to index data from multiple different sources, and they index it from cell phones, from sales receipts, from all kinds of different data. They're able to take this data in their own program, in their own language, and it puts it into a very common everyday language. That's why I think that this is such a unique company in that, yes, they have had ups and downs in their earnings, but the thing that goes up and down with the earnings is the fact that the expectations of what's going on. Big data is something that Yeah, it's been around for a few years, but the usefulness of it goes up and down with the economy and with the different customers that they might have. How does Splunk compete? Their biggest competitor right now is probably Oracle, and SAP also. There's a smaller company called New Relic, but they actually, if you follow the spaghetti graph as you see here, they compete pretty well with each other. Splunk's in blue; they're going to be over top of everything else, and I really think it's because of their usefulness. The software and the program, the language that they created and everything is very intuitive. The average person can use it without a lot of input from that standpoint. See, that was really one of the biggest useful aspects of something like Microsoft. Microsoft, the operating system, it works so well for the average person. You don't have to have a huge amount of education to be able to understand how it works. And that's the same thing with Splunk. Utilizing their data science doesn't take a data science degree to be able to utilize it. So that makes a big difference from that standpoint. Remember, though, as we talk about all these different stocks, the past performance is not going to be a guarantee of a future results. Now, remember, when we're talking about the moat, if you haven't joined us before, this is what a moat is. Remember, a moat is that imaginary barrier that you're going to see in between the company and between their competitors. So let's take a look and see actually why they have a narrow moat. They don't have a wide moat. They actually have a narrow moat. Probably the biggest thing that you're going to have in there with a company like Splunk, it's going to be just like Synopsys in a way. You're going to have a switching cost that's involved. It's a little bit different when we're talking about big data, because if you're going to another company, let's say, for example, if a Splunk user was going to go to Oracle or to SAP, there's always the possibility that there's some data that could possibly be lost. So it's actually just not a human hours time as a switching cost, or actually a learning curve for the switching cost. It's actually the possibility that there may be some data which is lost from one user and one carrier to the next from that standpoint. So that makes a big difference when we're talking about it. Another big benefit which Splunk has over top of some of its competitors, which actually does give it a moat, is the fact that they have the use of real-time data. They call it index on the fly or schema on the fly, and it's indexing data on the fly. They're using it as it's coming in and able to give real-time useful information. You're going to find that this is very helpful with restaurants, with airports, because they can use data that's coming in right now, today, at this very moment, and they can make real-time decisions. And that's a big barrier as far as like other companies being able to come in and do this. I'm not saying that there are no other companies that can do this, but Splunk is one company that has really carved a niche for itself, and it is a very useful software. It's a very useful program. And as I mentioned earlier, yes, one of the other benefits is that it does accept multiple sources for the data in itself. Okay, let's take a look and see what Morningstar says about Splunk. The price, as I mentioned before, is $194.07. And they're saying that actually the fair market value is a little bit more than that. So this is a different one, where we saw Synopsys trading at about 90% premium. We're actually seeing this particular stock trade at a small discount, close to a 3% discount. So, this is an interesting stock, because if we're going back to, let's go back to that political discussion that I brought up just a minute ago. In looking at the Wall Street Journal article, which I'd highly encourage you to look at, when it talks about the effects of a Biden presidency, growth stocks could be severely negatively impacted. But value stocks, which this would be considered a value stock on the cusp. In other words, it's not quite a real deep discount value, but it's selling a little bit under what the fair market value is. So this would be a stock that perhaps could be more in vogue at the point of time if we did have a Democrat presidency. So not to take one side of the political fence or the other, but you're going to have value stocks that hypothetically would benefit from a Democrat presidency, and you're going to have growth stocks, which quite frankly, the majority of stocks in the NASDAQ 100 are going to be growth stocks, which would be negatively impacted by a Democrat presidency. So, okay, let's keep going on and take a look and see what the average, let me make the screen just a little bit bigger for you because this next thing gets a little bit small. Okay, it's a 3-star company, according to Morningstar. Now let's take a look and see what actually the other companies out there say, the other analysts. And this is a company that's followed by a lot of analysts. There are 28 analysts that are taking a look and giving their opinion on this particular stock. 4 of them are saying a moderate buy. 5 of them are saying that it's a hold. And then 19 of them are saying it's a strong buy. So it doesn't take much to tell you that it's a strong buy. There you go. Okay, ring the bell. All right, so the idea is, as we're talking about these different things, I want you to keep this in mind, that the past performance of these investments is not going to be a future, guarantee of a future result. Also, I'm reporting to you what the other analysts are saying. I'm not telling you, Van Richards is not sitting here saying, hey, you need to go buy this stock because this is a good buy. You make up your own mind on that decision. All right. The other thing I want to remind you of, that if you need help with your retirement plan and if you need help with your investments and talking to you about how the stocks that you use today are fitting into your future, give me a call. Go over to my website at richardsfinancialplanning.com and you can find a 20-minute time slot where you and I can have a conversation one morning. There's no charge for it whatsoever, where you and I can have a conversation about what might be possible in your portfolio and what you might want to consider. And then we'll talk and see if there's any possibilities that I could help you going forward. But if 20 minutes I'll give you, cost nothing from that standpoint. But I just want to remind you that as we're looking at these different stocks today, and we're looking at all the different stocks today, tomorrow, and in days past, really there are only going to be 3 reasons that somebody that's going into retirement would want to have stocks. Number 1 is going to be diversification. Yes, you want to think about diversification. And there was another article, I read the Wall Street Journal quite a bit, and there was another article that was in yesterday's or this weekend's journal that basically alluded to the fact that there's no safety net out there when it comes to investing anymore, because all the markets kind of seem dysfunctional, and it's really the time that we're in. It's just not really in the United States. It's in other countries too. It used to be that if you had a growth stock, you could be in growth stocks, and growth stocks did not move the same as value stocks. And stocks did not move the same as bonds, and bonds did not move the same as gold, and gold didn't move the same as commodities. So you get the idea in there. But that's changed to some degree. It's changed to some degree. You will find that a lot of this is cyclical. And I've talked to you about this before, and I hope that that if you haven't listened to me before, that you'll listen to this now, that markets are cyclical. And when I say cyclical, what I mean is there's a long time period from the beginning of a cycle to the end of a cycle. Now, what's a cycle? A cycle is going to be from a low to a high. That's the general tendency that we've seen, since the beginning of this century. The idea is going to be that we're going to start with a lower price and you're going to be going to a higher price. Has that happened to you? Have you been in the investment markets and seen it go up? If you haven't, if you're a new investor, that's what you should be anticipating. This is what you shouldn't be anticipating. You should not be anticipating putting money into the market today and next week making a huge profit. I know that there's a lot of videos out there from day traders, and there's a lot of them out there that'll be hating on my video today because I'm saying this, but most day trading doesn't work. Most Bitcoin trading doesn't work. Most people, that's going to be 2 out of 3, let's say, and that's a bad percentage. If you knew that there was going to be a 60% chance of rain, would you take an umbrella? You probably would. If you knew that there was a 60% chance that you get struck by lightning, would you step outside? Maybe, depends if you were a daredevil or not. If there was a 60% chance that you were going to contract the coronavirus, would you go to a particular event? Questionable from that standpoint. So the whole idea is probabilities. The probabilities. When we look at the probabilities of benefiting from a market cycle, it's very high. Now, I can't say that it's going to be guaranteed because it's not. But the idea is that most people that invest in at least 2 cycles make a positive rate of return on their investments. And when I say 2 cycles, this is what I mean. 1 cycle is going to last from 4 to 5 years. Now, why is it 4 to 5 years? Because a bear market, remember, a bear market's when the investments are going down. Most bear markets, or we could say recessions too, that's when technically a recession is going to be 2 negative quarters of growth, of negative growth in the economy. And yes, we've had that, but it's actually gone beyond that. That's another subject. But the point is going to be that when we have a bear market, it generally lasts about 18 months. The one that we had this time lasted that long comparatively, but on average, they last about 18 months. The bull markets generally last for about 4 to 5 years. So when you put together a bear market and a bull market, and you have that happen 2 times, that's 2 cycles. If you can invest through at least 2 cycles, and you think of long term, it needs to be at least 1 cycle. If you can invest through at least 2 cycles, then you have a much better probability of making profits. You've got a much better probability of making profits doing that than you would in a day trading situation or in a Bitcoin situation. So all you guys out there that are tagging my videos for Bitcoin, I'm going to delete you. So just don't do it. But the idea is going to be, because I don't think that it works. If I thought that it worked, I'd be the first one that would jump on the bandwagon and say, this is something that you should consider. This is a case, I agree with Warren Buffett on a lot of stuff, but this is one case where I wholeheartedly support Warren Buffett's opinion, and that is that Bitcoin is not something that's going to be long-term profits. This is the reason why. When you own Bitcoin, what do you own? I'm waiting. What do you own? Nothing. You own nothing. When you own a share of Oracle, what do you own? You own a portion of that company. When you own a share of Walmart, what do you own? You own, actually, you're a part owner. If you have enough shares, you actually have some sort of say in the operation of the company. But when you own something like Bitcoin, you own nothing. All you own is a hope of what might happen. So, okay, I digress. The other 2 reasons that people buy stocks are going to be for growth. We've talked about that. And also income. There's about 60% of the stocks that are in the NASDAQ 100 that actually pay dividends. And that's another way for you to develop income for your retirement. So I've given you my opinion for the day, and I want to hear from you. Tell me what you think. What do you think? Do you think Bitcoin's worth investing in? If you're one of those traders out there and you've actually got a history of it, and you know that you've got a history of it and you can prove it, tell me about it. I'd like to hear about it. If you're a day trader and you have actually made money, not selling your program, if you've made money over 30 years, I want to hear about it. That's how long I've been in business. And I haven't seen too many day traders that have lasted that long. I can't think of any. All right. So with all that said, I'd like to invite you to come back tomorrow. We'll be back tomorrow about the same time at 5 o'clock, and we'll have 2 more stocks to look at. So I have a little disclosure to share with you at the very end. I hope you'll stick around for that. Have a good evening, and we'll talk to you tomorrow.